Welcome back. A lot to talk about. Unemployment rate ticking up to 6.4%. That is really not good news for many Canadians and the Canadian economy. Maybe it's better news for the Bank of Canada, who might be looking at this data for the month of July, making a decision on the 24th. Will it actually move the needle for the Bank of Canada? Will they just wait till September to cut? And ultimately, this is a really important conversation, and we'll just get right into it. Let's take a quick second and look at what's happened over the last little while. So first and foremost, many Canadians didn't really predict the rate cut for June. And then once we got the data in June for inflation for the month of May, came in at 2.9%, CPI core medium trim, obviously came in hotter than expected. A lot of economists, analysts wrote off a possibility of a July rate cut, pretty much dwindling it down to like single percentage points. And now, all of a sudden, we have unemployment ticking up to 6.4%, 1,400 jobs being pulled back. Obviously, a shift in the types of jobs that are being created. Those 15 to 24 not able to find part-time jobs, summer jobs, new to Canada individuals finding it difficult to find a job. We have higher immigration levels. Ultimately, that's a big concern, because we have more people arriving in Canada looking for jobs, whether they be permanent residents. Obviously, we have a pullback in temporary and student visas. Obviously, big problems there with some of these fake university and colleges. But is Canada really going to deport these people? What's going to happen as these people continue to contribute somehow into the transactions in the economy, right? Simply put, more people that arrive in the country, the more goods and services they're going to potentially consume, and that's going to basically change the needle. And now, what I think is happening is that we're starting to feel those effects, right? The data is now catching up to Canada when it comes to the unemployment rates. Obviously, they tried to maybe camouflage or basically manipulate some of these numbers by bringing in a lot of Canadians very quickly, helping to boost that GDP number. But ultimately now, as Canadians feel those pressures, they're not able to find jobs. Well, that number is going to potentially increase. And I think over the next 6, 8, 12 months, this may be a trend. Obviously, 1 month of data doesn't mean that it's going to be a trend for the next little while, but it is one that we should point out as the onset, as we've talked about on the channel. If unemployment ticks up, this is going to be problematic, because one person's spending is another person's income. So as we look at the Canadian economy right now, what is sort of happening, and the Bank of Canada has pointed to this on numerous occasions. We understand the Bank of Canada is looking at inflation, this price stability, the restoration in price stability to 2%, getting it back down there by 2025. Ultimately, it's not going to be a steady decrease, a trajectory down to 2%. There's going to be ebbs and flows. But the other more important thing is that the Bank of Canada is really looking at employment, maximum employment. And although they want to see softening in the labor market, I don't think they necessarily want to see it in the unemployment rate. They may want to see less jobs, these vacancies being pulled back, but there's a correlation. Less jobs being created, less segments of the market, service jobs, lower paying jobs not being offered, that's a problem, because you're bringing in people. Young Canadians are competing against new to Canada individuals for these jobs, and it's just going to be a snowball effect over the next little while, unless the government and the Bank of Canada really start to do something. What is it that they can do, right? Ultimately, we hope that the government starts to really address the immigration concerns and really start to limit all these students that are coming in for these schools that are really not schools, right? These fake diplomas. Nothing against the students that want to come to Canada to actually get an education in a regular university or college. But ultimately, what's happening with temporary workers and what is literally happening with a lot of permanent residents, as we still see Canada bringing in 400 to 500,000 permanent residents, as their goal is to get to 100 million by, I think, 2100. They have a big task ahead of them, and they have to have businesses that are going to generate jobs. And as we talked about, one person's spending is another person's income. And if you're just not, contributing into the economy, like I see a lot of people we talk to, if more people are not going to hire services or people to do jobs, we're seeing businesses, pull back because people aren't spending. If you're not walking into a store, you're not buying that product, They don't need to have as many members of staff, working the floors, right? Which means the company's pulling back. They're maybe not investing in new technologies. They're not investing in maybe opening up more locations. They're not, growing their business. They're not taking out loans to invest in research and development, productivity, new machinery. I mean, there's a huge knock effect on this economic situation. And as we start to see all these things sort of unfold, which the Bank of Canada governor really just talked about in Winnipeg not too long ago, like he's really laying out the groundwork. He's saying these are the problems. And just talking to an average Canadian, listening to their stories, as soon as we go out and they find out, hey, Aunt, oh, what do you do? Oh, your mortgages. Oh, what's happening with interest rates? When are they going to cut? And, those conversations, really the problem is the unemployment, right? The what's happening in the economy. Talk to average Canadians who have mortgages and kids and families. They're feeling the pressures from the current higher interest rates. Remember, this is what it's very important to understand, like as we draw this parallel, because as the interest rates remain higher for longer, as these Canadians renew into these higher mortgages, the renewal cliff, this impending renewal cliff comes, 50, 60% of mortgages renew in 2025, 2026. These Canadians are preparing for higher payments. They're not going to be contributing to the economy. Just as interest rates that have been higher for longer take time to strangle the economy, to choke the economy, to get inflation back down to 2%, well, now we're seeing the ramifications of that, the unintended consequences or intended consequences, depending on how you want to look at it, where the Bank of Canada has seen that unemployment rate tick up, less people spending in the economy. But finding this soft landing or this soft landing, this what they've talked about, the Bank of Canada wanting to try to land this perfect airplane. They're trying to play with these numbers. They're really trying to say, okay, we want unemployment to tick up to here, and then labor market to soften around there, and then we want, these Canadians are renewing their mortgages to pull back. It's like this entire balancing act is literally on a tightrope. And I think the Bank of Canada potentially may not stick this landing, and that's going to be problematic for the entire economy, because if they don't land this airplane, if we see unemployment just skyrocket, because as I mentioned, it takes time. Everything is a lag. All these data points are backwards looking. Inflation, backwards looking. Unemployment, backwards looking. Labor force participation, backwards. Everything's backwards looking. Now, all of a sudden, by the time we get into July, let's say they don't cut, and then in August, and then September, now there's already like 3 months of numbers that could potentially get worse. I'm not saying that they are, but they can. And at that point, the Bank of Canada is going to be like, okay, well, 0.25% is not going to be enough to slowly reignite the economy, right? We don't want to just throw gas on the fire. We want to sort of just, slowly bring the economy back to life, sort of just slowly breathe some air into the fire, not stoke it all in one shot. And if the Bank of Canada doesn't make the moves ahead of time or preemptively, that's my fear, is that they're going to have no choice in the coming months ahead if they don't cut in July, and if they don't cut in September, that they're going to have to hammer down once the economy completely flatlines. And that's scary, because now that opens up the conversation that, many Canadians are on the sidelines waiting to buy a home, which, yes, there's a lot of them. But as I said, I don't think there's a lot of Canadians that are going to be rushing back into the economy or into the market to buy a home and rush back into the real estate market, especially because of prices falling in certain segments, certain things that are happening right now. I don't see them happening like all of a sudden. And why I'm saying that is because if we think about back to what we were talking about just a little bit earlier about jobs, if I don't have the stability and the psychology and the confidence that I'm secure in my jobs and the business and the economy is operating at 100%, I'm not going to jump into the market, right? I'm not going to make that move. I'm not going to put myself at risk. So there's a lot of conversations that are happening right now. And I really think that we need to focus in on what's going to happen next. Let's keep a close eye on the economy, people. Let's see what happens with employment, unemployment, jobs. What do you think is going to happen? Do you think the Bank of Canada is going to cut in July? Think they're going to cut in September? Do you think they're not even going to cut at all? Let us know in the comment sections below, but we'll see you next week. Thanks again for stopping by.